Still having a look at capital allowances, let's have a look at movable assets. We are looking at the cost or the value of assets when we're looking at movable assets. The cost must exclude VAT if the VAT was claimed. This is in terms of section 23C. For section 11E, 12C, 12E, what do we have as the requirement for cost? Well, section 11E says we can have cost or value of the asset. Whereas section 12C and 12E, we are going to look at the lesser of the actual cost to acquire or the cash cost in an arm's length transaction. To this value, we will include any costs of installation, any foundations or support structures, moving costs as well. However, the moving costs will be written off over the remaining period. If the underlying asset is fully written off, then we will write off in full in the year when the moving costs are incurred. What we should not include in the cost of these assets is any interest and finance charges, because that is part of the financing and not the cost of the asset. Section 40CA, where we have the acquisition of assets in exchange for shares, where the cost of the asset is equal to the market value of the shares after acquisition, or if the asset is acquired for debt, the cost of the asset is equal to the amount of the debt. So those are just some rules around the costing if we purchase or acquire the asset in a different form, using shares or using debt. Connected persons, well, the cost will depend on whether input tax could be claimed in full or not, and that would be in terms of section 10(4) of the VAT Act. However, we do not need a special connected party rule, especially for section 12C and 12E, because it specifically states that it is the lesser of actual cost to acquire or the cash cost under an arm's length transaction. If we have a look at some of the detail, you'll see section 11E. Section 11E, all movable assets except section 12C or 12E, where 12E applies. With section 11E, mostly movable non-manufacturing assets, including non-manufacturing assets of manufacturing enterprises, would fall under section 11E. We apportion section 11E for part of the year, if that is when we brought it into use. We need to remember we will reduce it to a residual value of R1, so it does not get fully written off. Should there be loose assets, in terms of section 11E, we could actually write off the full amount up to R1 on these loose assets, provided the value of those assets is less or equal to R7,000. Now, that does not include where you've broken up a big item into many smaller items. So let's say a boardroom table and chairs. If you took each chair, they would be less than 7,000, but if you look at the boardroom table with the chairs, it would exceed 7,000. So in that case, you would not be allowed to use the loose assets rule. We get our write-off periods for section 11E in interpretation note 47 or general binding ruling number 7. Section 12C is not applicable to small business corporations, and section 11E may not be elected. So it's important for section 12C assets. If it qualifies for section 12C, we cannot elect to use section 11E, even if it is more beneficial. It applies to the machinery used in a process of manufacture or similar process, except for small business corporations. It also applies to research and development, but that's excluded from your syllabus. Only manufacturing assets of the manufacturing enterprise qualify for section 12C, not assets like office equipment, vehicles, etc. They would go under section 11E. We do not apportion 12C, so that's a big difference between 11E and 12 cap C, is that we do not apportion. It is only applicable to new or unused manufacturing assets. We will get then the 40, 20, 20, 20. If it is previously used, we would get 20, 20, 20 for the 5 years. Moving on to Section 11 Cap E, this applies to small business corporations. Section 11E may only be elected when it comes to non-manufacturing assets. So if we have a small business corporation and they have manufacturing assets that are less than 7,000, we cannot elect to use Section 11E. Anyway, it wouldn't be more beneficial because under Section 11.12 Cap E, we can deduct for manufacturing assets the full amount, 100%, in the year in which it was brought into use. When it comes to non-manufacturing assets, we will get 50, 30, 20, and then if we're dealing with a non-manufacturing asset, you can select or elect to use Section 11E should it be more beneficial. Again, like 12 Cap C, 12 Cap E, we do not apportion for part of the year. So even if you used or brought the manufacturing asset into use for one day in the financial year, you would get the full allowance. What are the rates? Well, for manufacturing assets, we get 100%. For non-manufacturing assets, we get 50, 30, 20. Let's have a look at an example for capital allowances on movable assets. Star Limited acquired Machine A, a second-hand machine, for 1.5 million and brought it into use in its manufacturing process on the 10th of January, year 1. So because we're using it in the manufacturing process, we should be considering Section 12C. It's second-hand, so we should know 20% for 5 years. Next, Star Limited acquired a new manufacturing machine B for 3 million and brought it into use in its manufacturing process on the 15th of December, Y4, so year 4. Star Limited spent an additional 50,000 on installing machine B. So because we're looking at a manufacturing machine, we should consider Section 12C, and it's new, therefore we should use 40, 20, 20, 20. Also remember that installation cost, we should add to the cost of machine B before we are calculating our capital allowances. It goes on to say Star decided to move to another site and both machines were moved on the 15th of July in Y5 at a cost of 10,000 for machine A and 60,000 for machine B. When we see moving costs, we need to remember that we can write these off over the remaining period. We've been required to calculate the allowances in terms of Section 12C in the years of assessment for year 4, 5, 6, and 7, and ignore VAT. So in year 4, if we have a look at machine A, this would be the 4th year that we have machine A, and it would be at 20%, that we would get the allowance on that 1.5 million. In year 4, we purchased machine B. Therefore, we will get the allowance for the first year, but remember it was new, so we're going to get 40% on the 3 million plus the 50,000 installation cost. In year 5, we still have machine A, for which we will get the last write-off for the last year for machine A, being the 20% of the 1.5 million. However, in year 5, we also incurred moving costs. And remember, those are deductible in line with how much we have left to write off on machine A. Because machine A is going to be written off now in year 5, we will deduct that full 10,000 moving cost for machine A. So 300,000 on the actual cost of machine A and the 10,000 moving costs. So we'll be able to claim 310,000. For machine B, we will be allowed to deduct 20% of the cost, so the 3.05 million, plus we will be able to deduct a portion of the moving costs in line with how many years we have left to claim allowances. In year 5, we still have 3 years of allowances, therefore we will get a third of that 60,000 moving costs, which we will be able to claim now in year 5. We will then get another third in year 6 and the last third in year 7 as we write off machine B. If we have a quick look at year 6 and year 7, machine A is fully written off, nothing to do. Machine B, we still will get the 20% on the cost plus the 20,000 moving cost for both year 6 and then again in year 7 when we have written the machine as well as the moving costs off in total. Now if we go on to have a look at an example for movable assets again, but now we are looking at a small business corporation. Electra Limited, a small business corporation, so when you see that you should be considering section 12E. Commenced trading on the 1st of September, year 1. Its year of assessment ends on the last day of December each year. Electra Limited acquired non-manufacturing machinery on the 15th of September, year 1 for 1 million, which was immediately brought into use for trade purposes. So where we see non-manufacturing equipment and we're looking at section 12E, we know 50, 30, 20%. It goes on to say a new plant costing 1.25 million was purchased on the 1st of December, year 1, and Electra immediately brought it into use in its manufacturing operations. So now we know that this is manufacturing equipment and therefore we would get 100%. On 29 May, year 2, Electra Limited moved to bigger premises, incurring moving costs amounting to 50,000 in respect of the manufacturing machine and 30,000 in respect of the non-manufacturing machine. Remember, moving costs, we're going to write them off over the remaining period for those particular assets to which they relate. We are required to calculate the allowances for Electra that they can claim for year 1, 2, and 3. With the 31st December year end, year 1, we would be allowed to claim on the non-manufacturing equipment or machinery, we can claim 50%. So we paid 1 million, so we'll get 500,000 as a deduction in terms of the non-manufacturing. In terms of the manufacturing plant that was purchased for 1.25 million, because this is a small business corporation, they will get 100% deduction in year 1. In year 2, the allowance on the non-manufacturing equipment is now 30%, so they will get 300,000 of the 1 million. The manufacturing plant is fully written off, therefore there will be nothing in respect of the manufacturing plant. However, remember in year 2 they incurred moving costs, and just like we had in the previous example, the manufacturing plant was fully written off, therefore we will claim the full amount for the moving costs on the manufacturing plant. However, the non-manufacturing plant still has 2 years, year 2 and year 3, therefore we will take half in year 2 and the other half of the moving costs will be written off in year 3. As you can see in year 3, we have obviously nothing to do with the manufacturing plant because it's been fully written off, and so has the moving. But however, for the non-manufacturing plant, we still have the million and we get the remaining 20%, so the 200,000. As well as the deduction for the remaining costs relating to the moving of that non-manufacturing machinery, we will now get in year 3.